Your pension tax relief is on the chopping block, and the Treasury's move could shrink your retirement pot for good. In the next few minutes, you'll see exactly what's at risk, what higher earners must do now, and how to avoid losing tens of thousands. Right now, if you're a higher earner planning your retirement, the Treasury is sitting on a decision that could cost you tens of thousands of pounds in lost tax relief. The current system lets higher rate taxpayers get 40% back on every pound they contribute to a pension. But according to leaked speculation and Treasury analysis, that's exactly what's in the crosshairs. The UK retirement landscape changes fast. From pensions to property, we track what impacts your future. Subscribe to Retirement Brief UK and stay informed. Policy changes, tax tweaks, market moves, Retirement Brief UK provides clear, timely insights and summaries that keep you one step ahead. Now, I need to be clear here. This is speculation. Nothing is confirmed until the Chancellor announces it on the 26th of November, 2025. But the reason we're talking about it now is that the financial planning industry, tax experts, and pension specialists are genuinely concerned this could happen. And if it does, it matters. We're talking about a potential policy shift that could fundamentally reshape how much pension contribution relief you actually get. And if you're already watching this thinking you're sorted because you've maxed out your contributions, you're not. This affects your strategy going forward, your timeline to retirement, and critically, whether you should be making decisions differently today. Here's what's happening. The Treasury estimates that pension tax relief costs them £28.5 billion a year in income tax relief alone. Of that, roughly 68% goes to higher and additional rate taxpayers. That's a massive red flag for a government facing what they call painful budget decisions. And we're not talking about distant speculation here. This is based on Treasury data that reportedly arrived on the Chancellor's desk over the summer. Let me break down what you're actually dealing with right now and what could be at risk. Here's how it works today. If you earn £60,000 to £125,000 as a higher rate taxpayer, you get 40% tax relief on pension contributions. A basic rate taxpayer gets 20% additional rate taxpayers at 45%. But here's the bit that matters. That relief is costing the government billions, and they've got massive holes in the public finances to fill. The Institute for Fiscal Studies has done the maths. They reckon that moving to a flat rate of 20% relief for everyone would save the Treasury £15 billion a year. That's the scale of what we're discussing. And here's where things get interesting. For higher earners, it would hit hardest. Someone currently claiming 40% relief would suddenly drop to 20%. That's not a minor adjustment. That's cutting your actual contribution power in half, relatively speaking. Let me give you a concrete example. Imagine you're 55, earning £100,000. You've got 10 years until you want to retire. Right now, you can contribute £20,000 to a pension. The scheme claims 20% relief for you automatically, and you claim back a further 20% on your self-assessment. That's effectively £33,333 working for you. If the government moved to flat rate relief at 20%, you'd get £25,000 working for you instead. Over 10 years, with investment growth, that compounds into a genuinely material shortfall in your retirement pot, and you're working harder to get there. You're having to contribute actual take-home money to reach the same pension fund value. That's the real impact. Now, this isn't random noise. We know this because ahead of every major budget, the financial planning sector, think tanks like the Institute for Fiscal Studies, and pension experts run the numbers on possible revenue-raising options. Pension tax relief has been flagged as a potential target multiple times in recent years. This time around, with the government facing what they call tough budget decisions, the speculation has intensified. There are actually three main options that reportedly appear in pre-budget Treasury analysis and that industry experts are discussing. First option, the one making headlines, is cutting higher rate relief down to a flat 20% for everyone. It's simple to sell politically. Everyone gets the same rate. The IFS and other analysts have estimated it could save around £15 billion a year. But here's the critical bit. This is all speculation until it's announced. The government could easily decide against it. Second option involves removing the 25% tax-free cash lump sum entirely or reducing it. Currently, you can take 25% of your pension pot tax-free at retirement. The government is sitting on £5.5 billion a year in tax relief by allowing that. That's a juicy target. The third option, and this is the one affecting employers and salary sacrifice schemes, is changing how employer national insurance is treated on pension contributions that costs roughly £15 billion a year in relief, according to the latest statistics. But here's the critical bit. This is all speculation. They could move on one of these, all three, or none of them. The flat rate relief is the most administratively straightforward, which is why it features most prominently in pre-budget analysis, but nothing is decided until the 26th of November. You're in your 50s. You're probably looking at 10 to 15 years of peak earning before you step back or retire fully. Those years are literally your last window to build a defined contribution pension pot with any meaningful government top-up. Once tax relief changes, you're looking at a fundamentally different equation for the decade after that. Here's what keeps happening in retirement planning conversations. People delay the decision. They think, oh, they won't actually do it. But they said that about inheritance tax on pensions, and the government announced in the 2024 autumn budget that from April 2027, most pension funds will fall into your estate for inheritance tax purposes. That happened. The Treasury follows through when the numbers demand it. And if you're relying on property wealth to bolster your retirement, buy-to-let, equity release, family home, you need to understand that this tax relief change directly impacts how much you can compensate for through pension contributions. Property wealth is relatively stable, but pension contributions with tax relief are genuinely flexible. If that flexibility shrinks, your overall retirement income picture gets tighter. First, and this is important, don't panic and don't make knee-jerk decisions based on speculation. Financial advisors across the sector are warning clients to stay calm. These are possibilities, not certainties, but equally, they're serious possibilities worth understanding. That said, if you're not currently maxing out your pension contributions, it's worth modeling the numbers. The annual allowance for 2025 to 2026 is £60,000. If you're contributing less, and you genuinely can afford to contribute more, understand what the current relief structure gives you. It's not about rushing into anything, it's about informed planning. Second, understand the architecture of your pension. Are you in a relief at source scheme where you claim additional relief through self-assessment? Are you in salary sacrifice? That matters because the administrative complexity of changing the system means some vehicles will be easier to modify than others. Salary sacrifice arrangements, which are increasingly popular, could be disrupted by changes to relief structure. Third, this isn't just about pension planning anymore. The inheritance tax changes coming in 2027 mean you need to think about timing. Money into your pension after 2027 sits outside your estate for IHT purposes. That's valuable. But if the contribution relief shrinks, the tax efficiency of that money changes. Look, let's be honest about this. All of this is speculation and only reportedly based on Treasury analysis. Nothing is confirmed until the Chancellor announces it. But the fact that we're hearing this from multiple reliable sources, that the numbers are this large, and that the government has specifically said budget decisions will be painful, that suggests this is genuinely on the table. Here's what I'd actually recommend. Talk to a financial advisor who understands both pension taxation and property wealth planning. Not to lock in decisions immediately, but to understand your personal scenario. If you can contribute more within the current structure, and it makes sense for your overall strategy, the window for doing that at 40% relief is finite. Conversely, if you're already maxed out and your retirement plan is sound, this is less immediately critical, though the inheritance tax implications still matter. And if you're in salary sacrifice, pay attention to developments. Changes to how that system works would give you some runway to adapt before rules change, but you need to know it's coming. The real bottom line here is this: the government needs money. Pension tax relief is £28.5 billion sitting in their spending analysis sheets. You're in the group that receives the lion's share of that relief. This isn't alarmism. This is reading the actual Treasury priorities and understanding where policy pressure points are. What's your biggest concern with pension tax relief changes? Are you worried about your retirement plans? Have you already sought professional advice? Let us know by dropping a comment below. If you found this breakdown helpful, don't forget to hit that like button and subscribe to Retirement Brief UK for more essential updates on the UK retirement landscape. We cover everything from changes to the property market, summarising news on legislation changes and market trends to practical advice for homeowners and investors. Ring the notification bell so you never miss an update that could affect your retirement planning decisions. Thanks for watching, and we'll see you in the next one.